Okay, let's go ahead and go through the solution to the intercompany sale of inventory problem. And again, here we see our various random numbers. First order of business, copy, paste as values. So we've got a bunch of fixed numbers now. And what do we have? We have Big owns 70% of Little. Starting in 2020, Little routinely sells inventory to Big for subsequent resale. So we're going to have upstream sales of inventory. In 2020, we have merchandise sold for $100, cost $70. Of that merchandise, 25% resold in 2020, 60% resold in 2021, 15% resold in 2022. Similarly, in 2021, we sold merchandise for $133. It had a cost of $79.8. 80% was resold in 2021. The 20% resold in 2022. There were no additional intercompany sales in 2022. Assume Big uses the partial equity method. We need to go ahead and record our elimination entries for 2020, 2021, and 2022. And also, assuming Little reports earnings of $100,000 each year, what would be the income to the non-controlling shareholders in each year? Okay, let's go ahead first and figure out the gross profit here. In 2020, sales of $100, cost of sales $70, gross profit $30. Likewise, in 2021, sales price of $133 minus cost of $79.8 is a gross profit of $53.2. Okay, our elimination entries in 2020. Okay, first order of business, we need to eliminate the sales revenue and cost of goods sold in the amount of the intercompany sales revenue. Next, we need to go ahead and, again, this entry here doesn't defer any income. That would be the entry we would have if all the merchandise has been resold. Now we have to come back and say, look, of this $30 gross profit, what portion of that is still unrealized? We need to defer whatever's still unrealized. Now we've only sold 25% of the merchandise to a third party. The other 75% is still unsold, which means 75% of that $30 needs to be deferred as unrealized. So we're going to go ahead and defer that by increasing cost of goods sold. And again, that's 75% of the profit. And we increase our inventory value. Okay, 2021. We'll do the same thing. First, we eliminate 2021's intercompany sales revenue and cost of goods sold. So $133, same amount. And again, we say, look, there was a $53.2 gross profit. Not all of that has been realized. 20% of the merchandise, or 80%, was resold. The other 20% was not resold. So 20% of that $53, or about $11, needs to be deferred. And again, we do that by increasing, our cost of goods sold. So 20% of 53.2. There we go. And we reduce our inventory. Okay, now we need to go ahead and carry forward this unrealized gross profit from the previous year. And again, our two questions. First, was this upstream or downstream? This was an upstream sale, which means the non-controlling interest is going to get their share, 30% of that 22.5. The other 70% of that 22.5 is going to accrue to the parent. And now we have our second question, is the parent using the full or the partial equity method? It says assume Big uses the partial equity method, which again means that Big did not correct their income to remove the unrealized gain, which means their income was overstated last year, which means their retained earnings is overstated, and so we're correcting their retained earnings. On the credit side, we now ask ourselves, where is that gross profit residing in our accounting system? It's in one of two places. If that merchandise has been sold, then we need to correct cost of goods sold. If it hasn't been sold, then we need to correct inventory. If some has been sold and some hasn't, as is the case here, we need to allocate it proportionately. So first, in no particular order, we'd say, okay, of the merchandise that we're carrying forward 75% of the merchandise. 60 of the 75%, or 80% of that merchandise has been sold, which means 80% of that 22.5 has been realized. The other 20%, the other 15/75ths, has still not been sold, and so that is being carried forward as still unrealized. Finally, in 2022, there are no additional intercompany sales, so that first entry is not going to be applicable and the second entry will not be applicable, but we're carrying forward two groups of, or two collections or two batches of unrealized gross profit from the previous year. So first carrying forward this, or we can do this one of two ways. Let's go ahead and treat those independently. So first, let's carry forward. This is the stuff that was left over from 2021. From the 2021 sales, all of the remaining merchandise has been sold, which means that all of that 1064 is now realized. So again, we carry forward the unrealized gain or loss the same way we always have. And we're going to split it 30/70 between the parent and the non-controlling interest. And now we say, okay, all of that merchandise has now been sold, which means we need to realize the income by reducing cost of goods sold. Similarly, for this unrealized profit being carried forward, this is the stuff that's being carried forward from 2020. And now in 2022, we're reselling the last of that merchandise, which means we're recognizing the last of that $4.5 that we previously deferred. And so I'm just going to copy the account titles and say, okay, again, the parent gets, the non-controlling interest gets their share, 30% of that 4.5. The parent gets their 70% of that 4.5. That's all been realized, and so that's all going to be an adjustment to cost of goods sold. Now, as far as the income to the non-controlling shareholders is concerned, in 2020, it's going to be their share, 30%. We start with reported earnings of $100,000, and we look at the elimination entries in 2020 and ask, how did these affect earnings? The only one of these that affected earnings was that 22.5 debit to cost of goods sold. So the non-controlling shareholders get their share, 30%, of the adjusted earnings, and the adjusted earnings are the reported earnings of $100,000 minus the 22.5 that was deferred. In 2021, same drill. They're going to get 30%. We start with the reported earnings, and we ask ourselves, how did these elimination entries in the middle affect earnings? Well, first we've got that 10.64 debit to cost of goods sold. That reduces earnings. And then we've got a $18 credit. Need a formula there. And then we've got our debit to cost of goods sold, which reduces earnings. And then we've got a $18 credit to cost of goods sold, which increases earnings. Then finally in 2022, same thing, they're going to get their share. We start with reported earnings, and we ask ourselves how these elimination entries affected earnings. And here we have two things. We have two credits to cost of goods sold, and a credit to cost of goods sold increases earnings. So plus 10.64 plus 4.5. Okay, so there we have the solution for the intercompany sale of inventory.